Good morning. This is Vince Lanci, and you are listening to the Gold Fix at 8 a.m. Uh, Recapping last week and looking ahead to this week. But today is a little different, a little special in that we had a report given to us last week on Friday that was actually quite aggressive. And we want to go through that report rather than just give our usual levels for trading. So we thought we would start out uh, with that report and make the most of it in the short time we can. Now usually we post our content or our giveaway or handout for the gold fix in the morning of the fix, but last night we posted it Sunday night. We hope to do more of that going forward. Uh, uh, this is the first time that I'll be sharing a computer screen, and I am no computer genius, but I do have children that play Fortnite and Minecraft on this computer. So if there's a little bit of a lag, I apologize. If you can't stand it, then you can open the post on the site. Go to opportunistictrader.com and click on Insights. And after you click on Insights, look for the post titled uh, "Gold will make new highs, 5-year highs in the next 50 days." We're going to start midway in the post with our conclusions to get them out of the way so we can get to the actual report. All right. Our conclusions to get them out of the way after reading his report and factoring in our own biases are based on Friday's close. And we'll get to today's activity in a second, which that spot on the right hand side of your screen that you can see. Our conclusions are that we see a possible breakup, that's not a divorce, into the higher trading range channel and see no cause to get hyper bullish. So that's a 70-30 chance in our opinion. Now, uh, people talk about pollsters, and pollsters don't really know what they're doing, at least lately, because pollsters will look at a tangent. If anybody's an options wonk, they'll follow what I'm saying here, or stats wonk. They'll look at a tangent on a curve and say, that's where we are at this moment in time, and then they'll extrapolate it. The only thing that you can extrapolate for sure in this world is human bias. I see something trending higher, I think it'll go on forever. Nothing trends forever. Everything regresses to the mean. Uh, uh, okay, asterisk stock market. That's actually supposed to regress to the mean with a drift, but we won't get into that. My point is this: everyone is subjective. Everyone has their own opinion. Those that pretend to be objective are lying to themselves. You have to be objective about your subjectivity, which means be aware that you have a bias and talk to other people with opposite opinions to see if your bias holds up. That said, our bias is 70-30. We think we have a breakup, 70-30 chance of a breakup into the higher trading range channel. Two, we are long and bullish as described above, it's actually below, with both a stop price disclosed and a reversal price undisclosed. Now, in the post itself, which we won't get to all of it, you can read it. We encourage you to read it. If you have questions, you can email us. Um, you can call us. You can find us on Twitter, and we'll answer them because a lot of that is uh, geared towards people that are already continuous listeners. I think we have a lot of new first time listeners, and a welcome to those of you that have joined us. There's no catch. There's no tricks here. This is a broadcast for fun, and it's for education. Obviously, would love you to join the Opportunistic Trader, but the point of this is to make you understand a little bit more about gold and make it less boring. Three, trade war tensions and the folly of the people involved necessitate caution. Sometimes I write pretty well. Resolution should be bullish as gold is not a risk off asset. Okay, we won't debate that right now. Gold's not a risk off asset. Talk to you later about it. But we can see the chance of an aggressive yuan devaluation as a tool to really stick it to the US markets and gold with it. Violently 50-50 is our opinion. Okay, forget all the other stuff I wrote there. The thing you need to focus on is that trade war tensions and the idiots who are speaking or complicating things make things worse. The higher trade war tensions are, the lower gold goes. The lower trade war tensions are, the higher gold goes. Why? Because it's inverted. It's an inversion. It's inverted to the dollar, and it's in dollar terms. And uh, uh, the less trade China does, the less money they make. The less money they make, the less raw materials they buy. and gold is one of those. So they buy copper to build. They buy oil to make plastic, to make GI Joe with Kung Fu grip. They sell that to the United States, and then they buy gold with our dollars. Well, they're not doing that as much. There's less trade. And this weekend was a very big weekend with some serious oopses to the downside on Chinese trade. Not good information to have coming out when you're in the middle of a trade war. I suggest you look into that. You can look into it on Twitter, and you can look into it actually in our chat room, because we post everything that you see on Twitter there, plus the value that we add. All right. Hopes of QT ending soon might still be okay. Mistake, may still be big in stock prices. Right. QT is the thing that I'm all about, and it's the thing that has been something I think that I've been on top of, and the market has not. Uh, uh, the market knows more than me in the long run. We know that. Any stock drop accompanied by a bond sell-off would be very bearish for metals, as it will likely accompany a dollar spike for reasons we won't get into here. All right. Point is this: there are a lot of algos out there that are selling stock. There is at least one huge algo that is selling stock when bonds rally, basically playing QE type of trade. If bonds rally, that's the bond market. If you look at the bond market, it's discounting uh, uh, 1 to 2 years of economic activity, and the stock market is discounting 3 to 6 months, as I was taught under a CFA. Now that could be shorter now, based on how the market behaves. If the bond market rallies, then and we're talking about a regular market, not a QE market. Then the bond market is telling you recession if it rallies. It's telling you no inflation, and then you would sell stocks based on that. The problem comes in when, and this is the problem when QT becomes too much, when bonds do not sell off and stocks do sell off. I mean, when bonds do not rally and stocks sell off. So when the bond market and the stock market should be inverted in a normal environment in terms of their correlation. But QT can make them in the longer run, at least at the end of QT, you will see bonds and stocks move the same way. And that's when people will get their faces ripped off. The stock market will sell off, bonds will sell off, and stocks will rally at first, and algos will get killed, and the stock market will probably go to 2000, and then that will be the end of QT. But we're talking about gold here. All right. All right. We're going to skip the gold skew part. All right. Go down to current bias. Our current bias on a monthly macro. That means 2 to 12 month trade, long above 1189 print, looking to sell or trail stop near the 12-month moving average. Weekly, long as described below. We're basically long at 1249.5 basis Feb on a weekly breakout on the VBS. Daily, we're indifferent and will continue to play both ways. All right. Free op trader webinar beneath there. Now let's go to the report that we want to discuss. Start with page 1. It's a short report, but he is honest in his work here. Okay, this is by Michael Oliver, I think. Yes, Michael Oliver. All right. Gold will take out 5 years of highs in the next 50 trading days. This is me reading this as a trader. All right. Where's the caveat? Nobody puts a phrase like that in there unless they're either selling books or they have a hidden caveat. Well, he has a caveat. One trigger will activate this headline defined on page 2. That's the red phrase on page 2. If you're following along on the not on the screen but on the actual website. All right. So there is a caveat, and the caveat is if the market settles above X, he believes gold will take out 5 years of highs in the next 50 trading days. An outlandish statement, no, and here's why. All right. So the first part of this is the sales pitch. Right. The second page is the explanation. It's not to take anything away from the report. He's a technician, and he certainly has. Certainly knows what he's talking about here. And in fact, he does come right out and say it. His trigger was that the market had settled above 1237 on Friday, and it in fact did. All right. The bottom in gold was in 2015 at 1046. So his thesis basically here, or the thing that he concerns himself with most is we have higher lows every year. He's not saying we have higher highs, but we have higher lows every year for the last 5 years. And that's a valid point. We have higher lows despite every reason. Venezuela sells, Brexit means a sale of gold, what have you. Gold causes cancer. Who knows? But gold is making higher lows every year. It's not making higher highs. Now, some would say that's a sign of management or manipulation, and some would be right. But this is a market, so either you trade it, you surf it, you trade it, you surf it, you fade it, or you get out of the way and don't trade it. It's one of the three things. Okay, the most recent decline in August reached 1161, he says. I don't have the snapshot here, but Larry Benedict called that. He wasn't trying to say it was just the bottom forever, but he was saying this looks like the bottom for now, a blow off bottom. And as a regression to the mean type of trader, he was spot on. At 1189, we got a buy signal to be long on a macro basis. So there you go. Gold is now back above 1240. Okay, thank you. When you take in the Vista in this monthly price chart only, you see a large range bound clump of ink with downside stabs. No new lows since 2015, no lows. Okay, all right. The resolution of the struggle should be rapid to the upside. All right. Could be is what I would say. The point being is that there's a reason that we stop in what's basically the 200-day moving average. There's a reason for it, and it's not to say it's manipulation, although people do think that. It has to do with how macro funds trade, and I'm not going to show you the pictures now because I want to stay on the report. But macro funds, and I've done actual other reports on this. Macro funds. I want to speak specifically about Jeff Gundlach. Uh, he may not look exactly what I'm looking at, but I'm pretty sure he looks at something very close. The 12-month moving average, which is in this post, I'm not going to scroll down to it now, is very key on a monthly chart for macro players. When the market crosses above it and settles above it at the end of the month, you have on average a 3% rate of return month over month after that. When it crosses below it, you have an average loss if you remain long of 1.5%, I think. Uh, that's not to say you shouldn't get short below it. I think you should. I just think it's written. It's just the stats are for people that are buying gold and holding versus buying gold and getting in and out. Now, why is this important for this report? Because Jeff Gundlach in June said get out of your longs in gold, and it had just crossed that 12-month moving average. And then when it got a little bit below 1200, he said, I want to buy gold. Now, to me, that says he uses the 12-month moving average or something close to it as an oscillator or as an anchor. So when it gets maybe 2, 3 standard deviations away from it, he buys it. When it gets to it, he sells it. And pay attention to this. A lot of macro players will use a moving average as an exit. When the market gets away from it, below it, they buy it. And when it gets to it, he recognizes that momentum buyers will come in and buy, crossing over that line above it. That is his exit liquidity for volume. So frequently, when a Gunlock or a Dalio or Soros sells, bullion banks sell along with them, if not in front of them, as they are entitled to do. There is no conflict of interest, believe it or not. But that's basically it. Now we're going to go to his reasons, and you can read more about it. But I want to show. Uh, Here you go. All right. Now this is the two. He noticed the first chart is a 200-day moving average. Now his 200-day moving average is very very important for a lot of people to look at. And by the way, if you trade silver, you know what I'm talking about. It constantly gets hammered at the 200-day moving average, way more than gold does. But gold in this instance is approaching 200-day moving average. Uh, to say if we break through it, and I'm a momentum trader talking here, folks. To say if we break through it, it'll go higher is yeah, that's true. There's probably stops to buy by momentum algo funds. There are stops to buy by momentum human funds. But there's usually wherever there are stops to buy in gold above the market. Now, I want to say always, but usually, wherever there are stops to buy in gold, that's where the people that are already long sell. So what you'll see is, if you want to translate this as a technician, which I'm not, you'll see a market make a new high. Let's say it breaks above the 200-day moving average for a day, an hour, a week, who knows? but it'll break above it, and you'll see open interest unchanged, and that's because you could see open interest unchanged. And that's because strong longs, Gunlock, who bought at 1190, is now selling to what I would call weaker longs, who are buying at 1267 or so. And the open interest remains unchanged because you have what's called strong hands to weak hands. What remains then is for the bullion dealers or the algos or people who look at things like stochastics, where you have a new high without a what do you call it? A negative. They have nice fancy names for it now, technical analysis. Basically, you have a non-confirmation. You have a new high in gold without a new high in something simple like RSIs, which is to say that the strength of the rally isn't there. Trading on lighter volume, people look at things like VWAP, but frequently what will happen is, and you could skip steps here, but the market will get to a 200-day moving average, and it may even break through it. And at first, they'll be selling there, and that'll be some guys selling. Some guys that don't have some guys. It could be bullion dealers selling in front of what they know is a big order above the market. It's a small market. But then there'll also be stops by momentum funds to come in. We'll settle above that line one day. The next day, we'll gap open 10 higher, just to exaggerate in an absolutist term. What ends up happening is that's where your liquidity moment is for large positions, for patient longs like Gunlock to sell, and they will sell into buy stops above the market. And then when that's done, if the market doesn't continue higher, then you will see more selling come in from initiating shorts from the commercial side. And then you'll see the market make new highs or close to it, but finish down on the day, still finish with a red candle, but up on the day. But you will see open interest go up. And that's because the strong longs got out and the strong shorts got in. And I want you to be very aware of that. Michael here is I like what Michael's doing here. Just please be aware that in a market that has a tendency to be bearish biased at the 200-day moving average, just to be careful of it. So basically, he said, if this week closes at or above, he wrote this on Friday, 1237. So it has. So his call is on, and I really hope he's right. Now, read at the bottom. However, our banner headline is based on our assessment of the red line breakout. Okay, the red line breakout is why I say in our conclusion that we are looking at the market going into another channel. Now, if you look at that downsloping green line he has there, that's a green line. That's a line that everyone has. Not to take anything away from Michael, but you have to have that line. There's basically two lines on a monthly chart, one sloping from the bottom up and one sloping from the top down. And those lines, the wedge of forever, they define the market right now. We've held them on the downside, we've held them on the upside, but I think there's going to be selling in that area at least the first time up. So if you're bullish and you're patient, you could wait for a pullback. Frankly, I think the level that matters the most from a macro point of view is 1267 in Feb, 1262ish in spot, and we can show a chart on that in a little bit. But overall, I think this is a good report. If I were to trade off of this report, I would say the final breakout is a weekly close over 2.5. Okay, I would say that between the red line and the green line, uh, if you think that the market's going to fail, 7 out of 10 times it does. You would be a seller of weakness below the red line. If you think that the market's going to rally, you would be a buyer of weakness approaching the red line. Now, the green line, that's because we're closer to the red line. The green line, if you're looking at that line, I would say you'd be a seller of strength the first time up if you had longs. If you were brave, you'd get shorts on. You would be a buyer of strength above that, but beware of a close versus a print below it. All in all, we bought last week on what was a weekly momentum breakout. It's 821. I don't have too much time to go into this, but maybe I can show what we're talking about. I would encourage you to read this technical analysis by Michael Moore. Uh, 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 if for no other reason, look at it as in not contradiction, but uh, uh, as opposed or as an adjunct or side by side with Michael Oliver's work. Basically, uh, today, right? I'm going to give you this for a day trader. This is an active. Now we're talking about active traders. In the February market, above 1242.80, between 1242.80 and 1249.90, you do nothing. Above 1249.90, you might want to get long or sell it as it goes back through. Below 1242.80, you might want to get short and buy it as it goes back through. The other technical numbers are on the left. A lot of his stuff is based on hourly charts in the micro, which is great for active traders. Gold is coming off now as we are watching. That's a 60-minute chart you're looking at there, and this is something that we actually talked about uh, in. Well, here we'll do a self plug. All right, all right. So you can go through this. Why the 12-month matters. All right, and so we'll just go through our signals for now. And those basically say be long above 1236 on a weekly close. This is what we did, and those are the chat room alerts for members when we did it. Okay, uh, this is the monthly. We don't care about the monthly right now. You can read it on your own time. But the 60-minute is uh, we wrote this yesterday before the market opened. The 60-minute, sorry about the lag there. The 60-minute gold is overbought, and even in the most healthy conditions, a retracement is in order. Okay, we're looking at a retracement right now. So that's 1244 at about 550. It's 1249 and a half. So we're actually below. um, uh, uh, we're right around the number that Michael Moore cares about, but we're still in a healthy spot compared to Michael Oliver. It's compared to what Michael Oliver says. So we are overbought. At least that's what I said last night, and the market has sold off. You want a reason for that? The reason is the dollar is, although the dollar is not stronger, it's basically unchanged. You are looking at uh, uh, the the cable, the British pound, getting hammered as a result of more Brexit indecisiveness or more Brexit fears. The euro is actually stronger, so there may be some conclusion coming out right now linking Brexit, linking pound weakness with euro as the benefit. We prefer to look at the yuan when it comes to gold, but uh, we would like to be buyers of gold in these areas, but we're not going to right now because we already have our positions and our stop out. So why don't we go to this and take a look at silver for a minute because we're going to be going soon. In fact, special treat today. We will be broadcasting the AM roadmap uh, uh, by virtue of the largesse of uh, Opportunistic Trader for the public today. We're not switching channels, so stay on this channel. And if you're an ES, NASDAQ, or oil trader, you want to pay attention to this morning because Larry Benedict, if you don't know who he is, subject of Jack Schwager's Market Wizards book, has managed $1 billion. And like Ray Dalio, he's a guy at a point in his career where he's more interested in adding some value and creating some interest in education. Of course, he'd like to be profitable at it, but the point of opportunistic trader is it's a way to level the playing field for people like himself, who he came from he didn't come from some Ivy League background. He's a guy who worked himself up through the ranks. I'm having a little bit of a lag here, but let's just say this. Um, I'm very, there's silver. Okay. So silver's trading 1448, and that's spot. 60-minute chart. Silver is really tough to look at on a 60-minute chart. But what you do want to look at is the most important currency right now with the dollar unchanged is the Chinese yuan. And I'll just hover my thing over there. That's the offshore yuan. That means it's higher. That means it's weaker compared to the dollar. And that's bearish. If the yuan rallies or gets weaker to the dollar, that's a sign of bad trade news for that's a sign of trade war negativity. So gold could be down and is probably down because of negativity coming out of trade. Who knows? Some other executive got arrested. Who cares? But uh, we care about the news only after the fact. We watch the market. But we will talk. There's another post on that. There's a peg in effect between the yuan and gold. I encourage you to look for that post on Insights. It's basically just a chart storm right now, but it'll be the subject of a future post. Please stay with us as we go into the chat room. We'll be switching screens, but as Michael Aronovitz, FX trader and uh, uh, guru of all things, will be taking the reins from here as we go into discussing today's markets. And by that, I mean all the markets, not just gold. And we all know that gold's the most important market. But uh, don't tell Larry that. Uh, anyway, it's 8:28, and that would be summertime blues, which I would love to have, given this weather in Connecticut. Have a great day, everyone. And I am signing off, but stay here